Dismiss that, and we're right back there. Okay. All right. What are allowable tax benefits? Okay.
Accident and health benefits.
There you go. Oh, she found the pages. All right, way to go. So what ends up happening is a lot of times what is considered deductible, okay, for tax purposes are accident and health benefits. Okay. Now there are some that are non-taxable. All right. Contributions that are non-taxable may include contributions to the cost of accident health insurance, including long-term health insurance care. Now, they are non-taxable, in other words, to the employee. Okay, they're considered a pre-tax situation. What they have to do is when they calculate for the employee's payroll, they actually take those funds out pre-tax. Now, what does that affect in regards to the employee down the road? Because they are not taxed when they're initially considered payroll. What does that mean about the payroll later on? About the benefits later on?
Because they're pre-tax, you mean?
Correct, because they're pre-tax. What does that mean about the payment for those taxes? When does it occur?
It occurs before the gross amount, before the net amount is taxed. So
okay,
it
so
occurs before the net amount is calculated.
Okay, but for the employees, even though it's considered a deferred tax, they're not actually tax-free to the employee. Okay, they take it out of the payroll, out of their payroll, so they are not getting taxed on that amount. So as a result, they get taxed on the benefit when they get it at the end.
Oh, I see what you're saying.
Okay, so the employees, it sounds really good. Now remember that. It sounds really good when you're first starting out because you think, oh great, I'm not having to pay taxes on this money, right? They will get their taxes. Okay, that's a good rule of thumb. The government, beyond anything else, remember what are the only two things that are guaranteed basically 100%? Death and taxes. Okay, there you go. Death and taxes. So, as a result, guess what? They will tax you on it at some point.
Got it.
Okay, so
you're taxed on it after you receive the benefit.
After you receive the benefit, you get taxed on it. And unfortunately, here, what's the bad part about that? Now, it sounds really good when you're going into it, right? I don't have a tax on this money, right? Sounds awesome. But let's say that you were paying on this in 1960. Okay, let's go back to 1960. You were working really hard in the 60s, and now you're retired, and now you're collecting those health benefits, that long-term care.
No, well, LTC is a little different, though.
Right, I know, but we're talking about, if you were paying a tax-deferred amount, like in the 1960s, and now you're collecting the benefit today, because there were policies back in the 60s.
Paying taxes on $4,000 a month.
But you're paying it at this year's rate.
Oh yeah.
Because I know that sounds like, well, it was great back in the 1960s. You didn't have to pay the taxes on it, but guess what? You are now paying the taxes on it at 2019's rate versus 1960s rate. Now, think about it. That's like, oh, great, awesome. It's like in some cases, maybe that's better. There are years when we actually paid much more in taxes than we do currently. I know that sounds a little strange, but there were situations where the taxes were over 50%. We do have years where taxes were up to over 50% of the income. That's a pretty substantial amount. Okay. But not all cases was that true, and in most cases that was not true. Okay, that was a very rare thing. So think about that. Even though it says it's tax deferred, that does not necessarily mean such a great thing. Okay. So tax
Well,
deferred amount.
although, Ryan, your LTC reimbursement is only taxable if they exceed your medical expenses.
Correct. Correct. And that's but here's the important part. Remember, that's actually based on today's laws,
Mm.
because that wasn't based on the laws back in the 60s and the 70s when long-term care actually first started becoming an issue. So they only passed those laws in usually, I think that was in the 2000s when they first started making those laws, which affected the long-term care, so that it was not. They changed the long-term care laws because of stuff like that. So I know that some have come into effect now that affected, but when they first started collecting stuff for long-term care and whatnot, they didn't even have those laws in place. So a lot of those are only in effect now simply because we saw issues with the way things were being handled. So yeah, but you're right, those are now in effect for it. But there are a lot of things that were tax deferred that we have that we end up getting taxed on down the road. Okay, and that's the important part. That was the point mainly that I was trying to make.
Okay.
That a lot of times tax deferred things, they sound great going into them, but it's you end up getting taxed in the end. And there are some that they've looked at now because one of the major things that they are trying to realize is that they have to pay for retirement. How do they pay for retirement? How does the government, I should say, have to pay for retirement now?
Out of the taxes that we're paying when we're working.
That's right, Social Security. But when do you pay for that retirement? Who is paying for the retirees right now?
The people that are working.
That are working today. The
Right.
people today are actually paying the Social Security benefits of the people who are retired now. It isn't what you paid in before. Okay?
Well, it never was.
It never was.
They
Okay.
raided that fund during the Vietnam War.
Yep. So what ended up happening is a lot of people don't realize that they say, well, I paid into Social Security all my life. Doesn't matter. You were paying for those people then. Okay. You weren't paying for yours. That wasn't a savings account for you. That was paying for the people who needed Social Security then. You're going to be being paid for by the people who are paying for Social Security now. And the people who are paying for me when I retire are going to be the people who are paying for Social Security when my kids. So we have to look at it that way. It's an ongoing process. If people aren't paying the Social Security benefits, then the retirees don't have income. So it does work that way. You're not building up a Social Security fund anymore. So
Yes.
you're paying for the current level.
Maybe in 1932 you were, but not.
Yeah, that's true. Maybe in 1932 you were saving up, and that was a great thought. But unfortunately, it's not true anymore. I wish it was. It would be a great thing if we ever got back to that. But we are so far in debt, we could never get back to that anymore.
They call it a trust fund, but it was never actually a trust fund.
No, it was never actually hasn't been a Social Security fund since
1933.
Yeah, it's like who knows? I can't even remember when. Pretty much the fund went away. We just started raiding it when we saw there's a whole lot of money there. So yeah. So think about it. Tax deferred does not mean you are not going to get taxed on it. It means you are not going to get taxed on it today. Now, for the businesses, what does that mean? Is the business going to have that as an expense?
For sure.
Yep, that's right. It's an expense to the business. So now there are some other ones. Adoption assistance. When a person adopts, think about it. A company can help you. A lot of times, an adoption assistant program can provide payments or reimbursements for qualifying expenses up to $13,570. That's how much is actually excludable in 2017. That's how much it was in 2017. $13,570, and I don't think it's gone up much, actually. I don't think it's actually changed in 2018.
13,180.
13. What's it now in 2018 for the adoption assistance?
I'm not 13,180.
Okay, because 2017 I've got 13,570.
It
So
went down.
it went down. That would make sense, wouldn't it? Because adoption expenses went up. Trust me. Yeah, adoption assistance is a big one, and luckily businesses can deduct that. Education reimbursement. You know, a lot of
I'm
companies.
sorry. 13,810.
13,810. Okay.
I interchange. 188.
810. Okay, so it did go up about $300. Okay, so it went up about what, $250, something like that. Okay, there we go. Okay. Also, there are education expenses. A company can actually help you with your education expenses. So a lot of times they'll say up to a certain amount per year, they will reimburse you for your education expenses. Okay, so that's a great benefit, and not a lot of people take advantage of it. And it's one of those things that a lot more people should take advantage of. So, okay, definitely, if you have the ability to take advantage of an education expense, do it. It gets passed on to the federal government as an expense for the company. So take advantage of that. Okay. Dependent care assistance. This is a big one. Now, understand something. The exclusion amount that they allow for you is barely going to touch it. It's $5,000 for married filing jointly and $2,500 for married filing separately. Okay, I got news for you. If you have a dependent care, it is one of the most expensive things there is. Okay.
Oh, yeah.
Honest to God, it is one of the most expensive things there is. That exclusion amount pretty much does not touch it. Okay. But it is an important thing. Okay. It is a very important thing. Hang on a second. Frank's calling me. Let me take this for 1 second here.
Yeah.
Sorry about that, ladies. He just had a question for me. So, okay. The group term insurance, as you know, group term insurance for an employee gets taken out pre-tax. Okay, so it is tax deferred, usually. But think about one thing: for a company, it's an expense. So it is an actual deductible expense. Now, let's get into the health savings account. Okay, the health savings account is actually fairly new. They haven't existed for a very long time. They came about because health accounts, people want to determine what their own health plans are. Okay, they want to be able to determine how their own health medical expenses are covered. Okay, how they are actually controlled. They want to have some influence. Okay, so what they want to do is they created the health savings accounts, and they are designed to allow an employer and you to make contributions to an account every year and allow you to direct where those funds go. Now, there are guidelines for it, so that what they're used for can only be used in regards to certain medical areas. And it normally involves things like your glasses, your dental work, things like this, okay? Certain medical procedures, and it's usually preventative care. A lot of the preventative care gets under the health savings accounts, okay? Now, those expenses for it, though, to the employer are deductible, okay? Because they are an actual expense to the company, all right? And that's the biggest concern you have, is the amount that the company contributes is deductible, okay? And that our concern is when it's on the W-2, that it is actually separated from normal income and that it's designated specifically as a health savings account, okay? And there's a reason, okay? The main reason is because there's also a flexible spending account, okay? And you want to make sure that the health savings account is separate because it has specific guidelines for it to meet the medical deduction. And the best part is because as a medical expense, it is actually much better for you rate-wise than a flexible spending account. The reason is flexible spending accounts are basically deductible at a different rate than a health savings account, okay? And a flexible spending account, well, we'll get into in a second, but a health spending account, because of its medical guidelines, it is only usable for certain things, but it is better for you deductibility wise, okay? Now, now think about this, is really important here. There it is here. I want to make sure I got this wording correctly because it's really important. In order to qualify for a health savings account, the employee must be covered by a high deductible health care plan. Okay, that one is important because, in other words, if it does not have a deductible, and that means it actually has to have a yearly amount which you have to cover initially before you're covered 100%. Okay, these came about, they used to be the healthcare plans didn't have a deductible, all right, and that was actually beneficial in a large sense, but now they have a deductible. Okay. So going into it, you have to have a certain amount of medical expenses that you are responsible for, okay? And also,
Are you should get that highly deductible plan from your employer?
yes, that comes from your employer.
Well,
And
the way that came about was because the health plans were so expensive to the employer that they
right,
developed a high deductible so
to
that
try
it
to
would
lower.
lessen their expense. But
Right.
in return, they established an account where they could put money for the employee to cover the deductible.
Correct. And they also did as well because there are a lot of people who don't use their health benefits. Okay, think about it. In a year, if you're younger, you're in your 30s, that sort of thing, do you often go to the doctor? A lot of times you're not going to the doctor, but you're paying as much for the healthcare benefits as you are somebody in their 60s, okay, who's still employed. So as a result, the healthcare plans came up with a deductible to make it more beneficial. It's a lower rate, but if you're not using your healthcare benefits, great, you don't have that deductible amount. So you're assuming some of the responsibility if you have that increased usage, okay? And finally, no contributions can be made to an individual's health savings account once he becomes enrolled in Medicare.
Mm-hmm.
That one is very important. The reason is Medicare is taking control of all of your basic medical expenses, and Medicare is actually based. It's based in a large sense on your income. Okay, so as a result, if you have a health savings account, that means you have a flood of available funds. So to compensate for that, if you go on Medicare, if you're now eligible for Medicare and you now enroll in it, you are not eligible for a health savings account any longer. And that is an important fact you really should know for the test.
Do employer contribute also to your HSA?
They can. Now, again, that's an option that the employer may or may not execute. Depends on your employer themselves. In a lot of cases, they do. Okay.
They
But
can
that is something that is,
contribute like every year so much money to
that
the
is,
HSA, and it can carry over.
yes. And that's one of the benefits that employers can do. And that's actually, there are limits that they can contribute. There are limits to it, but that is one of the benefits they can do. And that's an actual very good benefit, because not only do you contribute, but it's almost like sometimes they match the contribution, so you can actually set up how much you want to have in it. So there are different types of health savings accounts as well.
Mm,
Okay. And then you actually, those are the health savings accounts. All right. And there are certain things, and if you look, actually, we have in the handout there is a table, and those are the contribution levels. Okay, now, there is a couple of things to realize. A health savings account, when you have it, if you're 55 or older, you have an extra $1,000 that can be contributed to it, okay, above and beyond the normal limits. The reason is, why would you think that a health savings account person 55 and older needs more in their health savings account?
Because they're going to be sicker
They're
than somebody
sick
who's 30.
more often than somebody in their 30s. Okay, that's the most obvious reason. I mean, they are going to have more problems than somebody who's in their 30s. So they have that additional allowable amount. Now, there are also, for that high deductible plan, there are actual minimal limits on what has to be in place for that account. Now, by that, it means what the deductible limit has to be. Now, for a self only, now this is again for 2017, so we'll have to double check to make sure what the current one is. But for the a single person, it's $1,300. That's what your yearly deductible amount would have to be for it to qualify for a high deductible. Okay,
it's 1350 for 2018.
so 1350. I'm going to actually have to update some of these.
Hello, hola, it's Victoria.
So it's 1350 for 2018.
Victoria needs to mute her.
Yeah, actually, it's easy
Ya le
enough.
dijeron.
She's now muted. Okay. And for a family, it's
Yeah.
2,500 right now at 2017, and we'll have to look at what it is for 2018.
2,700.
2,700. Okay.
I have a question
Sure.
regarding the HSA contribution limit,
Mhm.
because it says employer plus employee,
That's correct.
self only 3,450.
Right.
2019
that
is
means
3,500.
3,500 for
7,000.
for the family.
Right.
For the family. You mean that's for employer and employee already?
That is the total amount that the combined can do. Okay, so if, let's say, an employer is matching you, and let's say it's $3,500, you could put in, what is it, $1,750, and they would put in $1,750 if they were matching you. Okay, if it was just you. And if you had a family and it's the $7,000 now, you would put in $3,500, and they would put in $3,500 if they were matching you. Okay. If they're not matching you, or let's say they put in, if whatever they'll put in half of what you put in. That's what some of them do as well. Okay, they match 50% of whatever you put in. So if you put in $2,000, they put in $1,000. Okay, so let's say you put in 5,000. What is the most that they could put in?
$2,000 for family.
$2,000 for a family. Okay, the reason is there's that $7,000 limit. Okay, but if you were to put in $3,000, they could put in $1,500.
Yeah, what do
Yeah.
you mean by minimum deductibles?
Each year, you have a certain amount that you're responsible for in healthcare costs. Okay, that's how they avoid some of the healthcare costs. If you look now, you're going to get billed for part of your healthcare, if you depending on which plan you have. When you have a deductible amount, what it's saying is for you to qualify for a health savings account, that means your yearly deductible amount has to be at least $1,300 or $1,350 for 2018 for a self-employed for a single person.
Mm,
If you're a family, you have to have at least $2,700 in 2018. So in other words, for you, your before they will do 100% coverage. Okay, they'll usually do a percentage coverage before that. Okay, so think about it this way: there's a deductible. It's like when you get into a car accident. Okay, when you get into a car accident, what happens? You have a deductible amount. That's that you know how they say you have a $500 deductible. That means you get into a car accident and there's $3,000 in damage, right?
yeah,
That means you have to pay the first $500 because that's your
okay.
deductible amount, and then they pay the remaining $2,500.
The insurance, yeah.
The insurance does. The same thing works with your health insurance that way. Let's say that you have a medical bill, and the medical bill, and it takes virtually with the medical bills, trust me, it takes no time whatsoever to eat up your deductible. Okay, but let's say that you have to go to the doctor and you have to get some X-rays and you have to have a cast put on your leg because you broke your leg, and the bill comes to $3,000, and it's just yourself, right? Well, you've already made the deductible amount. You're responsible then for that first $1,350 for 2018, and the hospital then will cover the rest. But from that point forward, the hospital, well, your insurance will cover the rest of it from that point forward. But for the year, now this is based on a year. This isn't based on a single case. This is based on a full year. Okay, your deductible amount is that amount for a year. So let's say you go in there and your first bill is $300. Okay, you're responsible for that $300. Okay, the next bill is $500. Okay, you're still responsible for that $500. Okay, so your yearly amount you've had so far is $800. But now your next one you come in there is something major, and your bill is $3,000. Okay, you've already spent $800 of your deductible that you've been responsible for. So of that, you're going to have what, $550 that's going to come out of that $3,000 that you're going to be responsible for. But all the rest then from that point forward is covered by your insurance.
And then where will the HSA come?
The HSA comes in for expenditures for things that are typically not covered by insurance, like glasses and dental work and things like that.
Okay.
Like if you have a crown you need to have done, okay, on your teeth. Those are normally not covered under dental work. So
not covered by your insurance.
correct. So what will happen is you have that crown to be paid for. So to pay for it, what ends up happening is you either have it out of pocket or you've got to finance it, or now what you have is that choice that you have this amount that was set aside by your employer and you that you can elect to use it for you. Maybe it's your kid's braces, okay?
Okay. Yeah.
Things like that. Or maybe it's your new glasses. Glasses are something you get usually every couple of years. These are reading glasses, but they're an expense, okay? And prescription glasses are not cheap. I got news for you. Prescription glasses are not cheap at all.
Yes. I got
Okay.
one.
And when you get done, you're talking it when you've added just a couple of things to it, like the tinting or the carbon fiber, especially in my case, I have such thick lenses, I cannot get glass lenses. My
Mm.
glasses would weigh like 25 pounds.
Mm.
Okay. So to get that, I have to get carbon fiber lenses. Okay. Because there's no way I could actually have regular glass lenses anymore. They look like I was wearing Coke bottles. Okay. And so my glasses, literally a pair of glasses for me will cost literally close to $1,000. As soon as I get the scratch resistance and the tinting on them and any normal frames. And so I don't ever wear glasses. I always get my contacts. And that's another thing too. Your contacts are another expense, and they go under the expense of glasses. Okay. I wear extended wear ones where I can leave them in for, well, I'm supposed to leave them in for just 2 weeks. I usually leave them in for like 2 months, but but you're only supposed to leave them in for 2 weeks. Well, that's like glasses. And those are an expense that I choose to have, but that's what I use for my HSA. And that's what the HSA accounts are for. And you have to understand that and explain that and be able to use that for your clients and explain that to your clients. Then we have the flexible spending accounts. A flexible spending account is a lot different than your regular healthcare dollars. Now, understand something. They can be used for other benefits other than medical expenses. Now, they can be used for medical expenses, by the way. But what it is it works for all those extra ones. Okay? The HSA plans can only be used for medical expenses. The flexible spending accounts can be used for those medical expenses and all the other stuff. In other words, if you have daycare costs and things like that that are not covered normally, term life insurance premiums you're responsible for part of, things like that, that's what those flexible spending accounts can be used for. Things that you have your part that you're covering, that's what that benefit is for. Okay. And they, unfortunately, these are normally a benefit that is provided by the employer. So in other words, it's not something you normally contribute. It's normally something that the employer contributes.
Okay.
And so it's not something you normally put into it. It's something that they actually just provide for you. And it's normally a certain amount. And what it says is it cannot carry over, so you can't save it up. So it is a use it or lose it account.
Well, up to $500 in unused funds can be rolled over.
Can be rolled over, right. But in general, it's pretty much you're not going to typically hold on to a whole lot of it.
No, but with the other one you can.
With the other one you can. With a health savings account, you can carry a health savings account over, and that's an important fact. Now, that's one of the differences for it. But with a flexible savings account, it's for all those other expenses that it didn't cover that you may want to use it for. Now, again, you may use it for your health expenses. Okay? It can qualify for these. The health savings account has to be used for these expenses. Okay? These medical expenses.
Can you have FSA and HSA?
And HSA, yes.
You can have both.
You can have both. But what happens is
which comes first to use?
it doesn't matter. That's you're deciding it. Okay? Because it's your expenditure. But remember that your HSA can only be used for medical expenses here.
Yeah.
FSA can be used for these and these, all the other expenses, your other benefits that you would want to, that you have to pay for. Okay, they can be used to pay for those premiums. They can be used to decide, okay, I want to carry this kind of additional life insurance, or I want to carry this, I want to carry the additional daycare coverage, or I want to carry, this or whatever it may be. Okay, the other benefits that you would have to pay the premium on, that's what it's to help pay for. Okay, but that it can be used to cover the healthcare ones, but it also can cover the additional ones. Okay. Now, it is not one that always exists. A lot of places have a healthcare one, but don't have a flexible one. They have a healthcare account, but not a flexible spending account. Okay. So you have to realize that. You have to think about that when you look at your benefits package. Now, granted, most people, a lot of places don't even have a benefits package. Okay, realistically. But if they do, that's how the flexible spending account works. All right. Huh. Yeah, here we go. The working condition fringe benefits. Working condition means where you work has to be something that is consummate with the job you do. If you are on the road all the time and you are doing sales, or you are working out of your vehicle, or you're doing transportation, you are a truck driver, that sort of thing, your job requires you to be on the road all the time. Well, that means you are going to need certain things to be on the road all the time. You're going to need a laptop. You're going to need Wi-Fi in the vehicle. You're going to need a cell phone. You're going to need basically a desk in your car. You may need a scanner in your car. You may need a printer in your car. You may need filing cabinet in your car, one of the little portable filing cabinets in your car. Okay, a lot of times insurance agents have to go from client to client in their home. And an insurance agent, remember something, and an insurance agent technically works for the company. Okay, so they have to be provided with a work environment which actually allows them to work on the road. All right, a salesman, if he's doing sales, he's got to be able to go, if he's doing his office to office sales, going from company to company, he needs to be able to do face-to-face sales beyond the phone. Now, here's an important one, especially what is an important one for Oregon about doing sales on the road? What's one of the most important things that has come about recently that affects the salesman on the road? It's a simple law.
Oh, the one where if you have to pay more than they allocate to you, it's not, you can't write it off on your taxes anymore?
That's an important one, but there's one law that actually is, I think, for a salesman is more important than that. What can't you do in the car?
What can't you do in a car?
What can't you do in a car now in Oregon?
Write contracts?
You cannot touch your cell phone.
What?
You
On
cannot
the road?
Oh,
touch.
it has to be hands-free.
It has to be hands-free. If you touch your cell phone in the car, it is now official that if you touch your cell phone in the car, it is a ticket. How many salesmen are always on the phone when they're in a car?
Everybody.
Everybody. Well, okay, everybody and their brother's on their phone in the car, but especially a
But yeah,
salesman.
salesman. I mean, because you're going to a location, you're talking
Your
to
life is on that phone. So for a salesman, he needs to have a car that's equipped with the ability to actually talk on his phone. Now, ironically enough, my SUV. Now here's one thing: if I'm in my Mustang, can I do that? Mine's a 2003 Mustang.
No.
Not at all. Mine doesn't have. I've got a mock stereo, and those mock stereos were made in 2003. I got news for you. It does not have Bluetooth. It does not have, so guess what? It does not work for hands-free until I upgrade that and put a entirely different stereo into it. It would not work as a hands-free car. Okay, but there's an exception. My SUV, I have a 2013 Kia Sorento that was set up specifically. I wanted, when I got it, I specifically got what's called the luxury edition. There's a reason I did, because I wanted it to have certain things. You ever had a factory installed Bluetooth stereo system with the phone function, or have
Mine
you?
is.
Okay, now you have a very good situation in that case, because what happens if you have an aftermarket installed stereo system with the phone function?
I don't know.
I had one in my other car, and guess what? The microphone is an actual separate microphone that's kind of clipped on up by the top. Never works very well. It works somewhat okay, but it doesn't work very well. If you have a factory installed one when the car is built, that's built into your car and part of the car, guess what? My microphone for my stereo system in the SUV is actually built into the head roof, into the actual material. There's a microphone that is part of the actual overhead, and it picks up it's set over the driver's head, so it picks up his voice.
Mm.
And guess what? It actually works. And it's a good microphone. And it is
Never knew where the mic was.
Yep, and it's hardwired into, it's not just a plug-in microphone like the other ones are. It is a hardwired microphone into the stereo system, which links by Bluetooth to my whole phone, which has navigation and everything, right into my dash, which my dash is a touch dash, so I can actually just touch it. I don't have to do anything to it. I just, if I need to do something, and all of my controls for the stereo and the phone are built right into my steering wheel. So if I need to dial something, right on the steering wheel, I can hit voice control, dial, pick up, hold, whatever, right from my steering wheel. I never have to take my hands off the wheel. If I want to change the song even, I can do it right from the wheel. And my cruise control. That's, so it's set up so if I'm on the road, I can actually do things without taking my hands off the wheel and taking my eyes off the road. That's a major thing. But that's a thing because I'm on the road all the time. Okay. And I need to be able to talk to people. And so I wanted that feature on my car. And that's especially true in Oregon because the law now states if you touch your phone, it's not now just a matter of are you texting. If you touch your phone, okay, pick it up, you now have to have you can use one finger pretty much in Oregon. Okay, you cannot hold the phone in Oregon. Okay, you actually have to just be able to one button touch the controls for your stereo is the most you can do on it, or your phone. Okay, or they can ticket you. The reason is too many people are sitting there, and now unfortunately that's as a result, people are now looking down in their lap like this all the time. You'll see them as sitting at a stoplight going like this. Why? Because they're reading the phone in their lap, okay, and trying to text it. And it's actually probably more dangerous this way than it is if they were holding it or holding
Yes.
it by their ear. But what's happening now is they're actually burying their head down in their lap while they're trying to text or whatever to hide the phone. But that's the law now. in Oregon. And now in Washington as well, it says you can't actively be on the phone with it next to your ear. You have to use the hands-free feature, which is really important. So that's an
Even
important.
in Washington?
In Washington, you'd have to use it for the hands-free, but you can. Who's calling me now? Getting calls about the class. So anyway, you need to know that. So the environment that you're working in, especially when you're doing things like sales on the road, if you're a truck driver, what does that mean? Think about it. Truck drivers have to account for where they're at all times. So now trucks, what do trucks now have so that they know where the trucks are all the time?
Tracking.
GPS tracking, GPS speed tracking, GPS location tracking. They're constantly in touch with their dispatchers. The drivers don't have anything to do with it. The truck talks to the dispatcher. Okay. And that's because they don't want the driver to have to stop now, because it used to be at one point, the drivers were required now to stop because they were on the phone and would take the phone and say, I'm here or wherever, to let the dispatchers know where they were at. Now it doesn't even occur that way because they needed to know specifically where the trucks were. They now know where the trucks are and how fast they're going. Okay, because it tracks how fast they're moving. So those are things that the working conditions require these people to have working conditions for what they're doing. Okay, so you might understand something that a lot of times there are things that are required for your job, and there are a bunch in the examples: fire trucks, police cars, hearses. Okay, now I'd hate to think about the fact that your hearse is actually your company car, but yep, it is. Think about it. You're not going to haul somebody's casket around in a Volvo. Okay, typically. You might, but maybe in the back of a pickup truck if you're a redneck, I suppose, But in most cases, it's a nice big black hearse in most funerals. Well, that's a required car. School buses, cement mixers, tractors. Tractors are a vehicle on the road. Well, they got to be set up for being on the road. They have to have the slow moving vehicle sign. They have to have certain lights now. Okay, and the more important thing, what is interesting about a tractor? What's actually the law that what is a particular law in regards to you driving a car? What do you have to have?
Right of way.
Right of way, but when you're driving, let's say you're in the car driving, what's the first thing you have to have?
License.
Well, license, I'm thinking more physically.
Seatbelt.
Seatbelt. Thank you, Naomi. Okay. Think about something. Do they have seatbelts on school buses?
No.
Do they have seatbelts on tractors?
Nope.
No.
Nope.
Well, think about it. Aren't you driving down the street on a tractor?
Well, if you rolled over a tractor, you'd be in a world of hurt if you had a seatbelt on.
Yeah, that's true. Well, actually, if you roll over in a tractor, no matter what, I've actually put one in a ditch before. It's no fun either way because there's no protection. It's like seatbelt on a motorcycle. Think about it.
Yeah, right.
Okay. So, hey, think about it. There's no protection for anybody on the vehicle. Okay. So, seatbelts. What is the actual law for a seatbelt?
Have to have the seatbelt on while the car is moving.
You have to have the seatbelt on if it's available.
Uh-huh.
Okay. That's what the actual seatbelt law is. So, in other words, on those older pickup trucks, did they have seatbelts?
No.
Nope. Do you have to wear a seatbelt in those cars?
Back then, hell no.
Nope. Today you just still don't either because they weren't designed with a seatbelt. If the vehicle does not have a seatbelt designed for those seats, you don't have to have a seatbelt. And now here's another question. If you have six people in a car that's designed for 5 people and it has 5 seatbelts, how many people have to be seatbelted in?
5.
5. 6 people can sit in the car, and 5 people have to be seatbelted in because the car is designed with 5 seatbelts. It's not designed with 6 seatbelts. Okay? The 6th person is not required to have a seatbelt because the car is not designed with that seatbelt. It's an interesting fact. It's the same reason they can get around requiring buses to all be retrofitted with seatbelts. Okay, because the law says is what vehicles have that if the seatbelt is there, you're required to use it. So, otherwise, they'd have to go back and spend millions of dollars on school buses. They didn't have to retrofit cars. Okay, so the law is specifically written that way for a reason. So, those vehicles that we have there, like tractors and that sort of thing, don't have to have seatbelts, but they do have to have certain things in place for the driver. Okay, has to have certain security features for the driver. All right, and it has to accommodate his use of the tractor in certain situations. Okay. All right. So what we're going to do is this. Frank needs me, so we are going to end it there for the day because that's a good place to stop because we're going to get to the accountable plans here. All right.
All right.
And then we're going to go on from there. Sound good?
Yep.
Yeah, on Monday.
Actually, I'm going to try to do one tomorrow and record it. Okay. But
The
we'll
accountable
probably,
plan.
the accountable plans and whatnot on Saturday. And I'll have it up there for you if you want. Okay. Does that sound good for you guys? Will you have
Yeah.
time to watch it?